What you don't know about Medicare could cost you money. Hi, I'm Dave Lopez, founder and managing member at ILG Financial.
And I'm Chase Lopez, financial advisor at ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning. And don't forget to hit that like and subscribe button right below so you can be alerted of any future videos. So when we're planning for retirement, Dave, there's often a checklist that people have.
Yes, that's
Do I have enough income? Do I have enough money in my accounts? How is that all going to kind of work as we enter this new phase of our lives? But one thing a lot of people don't take into consideration is Medicare and Medicare premiums and how that all kind of ties into everything.
Yeah, it's the forgotten risk.
That's
We
right.
talk about the forgotten risk.
That's right.
But we don't forget it.
That's right.
Right? So here's one of the things you have to understand about Medicare Part B in particular.
Correct.
Right?
Yep.
So Medicare Part B for 2024, most folks, the base rate for everybody is about $174 a
That's
month.
right. Yep.
$174.50, something like that.
Yeah.
$174.50. And that's everybody pays the same rate for Medicare Part B. Kind of. And what I mean by that is if you make too much money, you pay an extra bump on top of that. And the more you make, the bigger the extra bump is that you make it. And how do they determine if you make too much? It's what's called, in our industry, a 2-year look back.
Right.
So what they're going to look at is your tax return and your recorded income for 2 years ago to decide what your Medicare Part B would be in 2024. So for 2024, they're going to look at your 2022 tax return.
That's right.
To decide what your premium should be this year. And next year in 2025, they're going to look at the 2023 return. Now that gives us some chances, knowing how it works. Hopefully you can go to your financial advisor or your tax professional and say, look, let's do some tax forward planning here so we have no surprises on this penalty, because it can be severe, this extra bump on Medicare.
Yeah.
And walk us through that.
Yeah, absolutely. So to piggyback off of your point, Dave, if you're turning on Medicare at 65, it's based on your age 63 year income, right? So for kind of a reference point for folks. But let's look at the chart as far as what this could kind of look like. So there's 5 income tiers above the standard bracket, the $174 per month that you were referring to.
That's that top bracket.
Correct. Well, the 174 is the base, right? And then we have 5 income tiers that you can see on the screen here above that. So if for a married couple, if your modified adjusted gross income is less than $206,000, then you're sticking with the 174, right? If you're from $206,000 to $258,000, your total Medicare Part B premium is $244, and it goes all the way up to it could be as much as $594. You see that at the bottom of the chart there. If their combined modified adjusted gross income is greater to or equal than $750,000.
Yeah, well, now while the chart's up, look at that first one, Chase. Just if you just jump that first bump, right? So you and your spouse show an income of over $206,000. Your Part B goes to $244. Well, if you do the math on that, that's $70 extra each.
Right.
That's $140 extra for a married couple.
Right.
A month.
Right.
$140,000 a month. That's $1,680 a year extra. Think of it as a tax you're paying as opposed to your neighbor, and you're both getting the same Medicare Part B.
Right.
All right, so back from the chart here, now let's kind of talk about what's so insidious about that. What's insidious about that is that you heard Chase refer to modified adjusted gross income. So one of the things you need to know is that term is thrown around in the tax world. And it can mean different things depending on which tax they're talking about.
That's right.
For example, your modified adjusted gross income for deciding if you're getting a surcharge for your Medicare is based on your adjusted gross income, which is line, I believe, 11 on your 1040. Let me check my notes. I want to make sure I get my line right. Line 11 on your 1040 is your adjusted gross income. That determines your tax rate and your taxes.
Right.
So they modify your adjusted gross income to decide if you have to pay extra Medicare.
Right.
Right? And they modify it by adding everything on the adjusted gross income plus any, and this is a key one, tax exempt interest. Now, this is one we kind of scream from the mountaintops that when you hear something's tax free, be careful. Sometimes it's only kind of tax free.
Right.
And I can't think of a better example than municipal bonds. Municipal bonds avoid federal income tax. So in that sense, they're tax free. But there's many other situations where your municipal bonds are taxable, and this is one of them.
Yep.
What they're saying is when they're deciding if you have to pay that extra $70 each in Medicare, they count your interest from your municipal bonds. So your municipal bonds may cause you to pay an extra $1,600, $1,680 a year in this case.
Yeah, and I think you put it well, Dave. Whenever they say tax-free, I feel like they should put a little asterisk next to that. When it's only tax-free on that line 11 on your 1040, right? Other than that, it can be added to the modified adjusted gross income, like you had kind of said.
And the comment on that modified, remember I said it's different things? You'll hear them say there's another tax, a net investment income tax.
Right.
That if you make too much money, you pay an additional tax on top of capital gains tax, net investment income tax. And to decide if you have to pay that extra tax, they look at your modified adjusted gross income. But in that case, they're looking at something very different than just your adjusted gross plus the tax exempt. So it's a little different depending on what you're looking for.
Sure. And I think one thing that we should point out to folks is, and a lot of people just don't internalize this, which is if you're just 5 cents over that threshold, if we can put that chart back up, take a look at the chart. Let's say the first line there where we say less than or equal to $206,000. If you had a modified adjusted gross income of $206,000.50 or 5 cents, you were 5 cents over, you would have to pay that additional, what did you say, $1,600?
$1,680.
Yeah, so it kind of brings to the forefront a lot of planning is necessary when we hit this Medicare age, right?
Yeah, you don't wade into it, so you need to get that right. And you can, there may be nothing you can do.
Right.
But you are able to plan, so if there is something you can do. So what could you do? Well, you can start to look at some incomes that you can control. You may defer selling a stock.
Right.
Or taking you may not want to take some income because the income you make is going to be less than the $1,680 you have to pay in Part B. So, or you may defer that income to next year, but there are things you can do. Now, you can't do anything with your Social Security.
Right.
Arguably, you can't do anything with your pension if it's already on.
Right.
So we're really looking at other streams, but you don't want to just stick your head in the sand like an ostrich and say, well, I guess whatever happens, happens. Because what we're here to tell you is that there are things you can do with this and other financial planning aspects of your retirement. To every little bit we save is more money in your pocket. And you want somebody looking out for those things, and your financial planner should be. And don't be shy about asking them.
Yeah, and that's kind of a good segue, Dave, because so we're talking about that age around 65, right? You turn on, you start Medicare, right? That's when you start. Yep. But you could be in the previous example, you could be under that $206,000 threshold at that time, right? But with what a lot of folks don't realize is with your traditional IRAs or your traditional 401ks or traditional TSPs, you are required, and we have another video about required minimum distributions if you want to take a look, but you are required to take money out of those accounts, which makes your income higher, doesn't it? So you could inadvertently, without even knowing it, be setting yourself up to have this big required minimum distribution once you get into your 70s. Not only are you paying tax on that, but that might trigger some of these additional surcharges for Medicare in the future.
Yeah, and it's doubly hurts because it's not like it's real income to you because it's money you already have. You're just recording it as income,
right? Paying
extra tax. But then you have to, if you don't need the money, you just reinvest it. But then you can't even reinvest it in a tax-free or a tax-deferred account. So it's not a pleasant situation, but it's a piece of the puzzle that we can control. So one of the things you need to know is that when you're deciding, is there anything I can do well before I hit RMD age, which for some of you is 73, some of you 75,
Right.
if it's not already on, right? Get with your financial professional based on your age to see which is which. But there are things we might be able to do to lessen the RMD hit or eliminate it, right, in the early years, so that the last 20 or 30 years of your life, we've controlled the fact that we don't have that extra Medicare charge.
Right.
It's doable if you have some time and you've got somebody who knows what strategies to employ.
Yeah, so if you haven't talked to your financial professional about this Medicare surcharge yet, strongly advise you to get with them, and we'll talk to you next time.
See you next time.